The information and opinions expressed in this video are of a general nature and are not intended to be investment advice, research, or recommendations. Please consult your investment professional for your own circumstances. The information in this video reflects the opinions of Arca Labs and the video's participants on the date of production and are subject to change at any time without notice due to various factors. Arca Labs is separate and unaffiliated from any third parties participating in the video presentation, and Arca Labs is not responsible for any third parties' products, services, or policies.
Welcome to Tokenization Talks, powered by Arca Labs. I'm Annelise Osborne with Arca Labs. We are focused on innovating responsibly. We are excited to bring you institutional thought leaders in the digital asset space. Our guest today is Marc Nichols, who is product director at Arbor Digital. Arbor Digital's mission is to connect RIAs to the world of digital assets. Their parent company, Arbor Capital Management, is based in Alaska with an AUM of $300 million. So Marc, thank you so much for joining us. I really appreciate it, and I love what you're doing in the space.
Annelise, I appreciate the invitation, and I'm so happy to be here.
Great. So why don't you share what you're focused on, what you're doing, and kind of we'll take it from there.
Absolutely. So as you mentioned, I am product director at Arbor Digital, which is a SMA, separately managed account investment solution for RIAs across the US. And as product director, I get to wear many hats, mostly around not only the portfolio management of our offerings, but then also just the sheer client experience and the product delivery of incorporating in a digital asset investment solution for investment advisors in the independent space. So that's kind of my role at Arbor Digital. And then overall in the industry, I feel we serve as a role to help connect RIAs, wealth managers, financial advisors to this emerging asset class that is digital assets in a safe and secure way. Because from what we know, and what I'm sure you all have seen as well, is that there are many different ways to get engaged, but not so much easy or safe. And there's a lot of different things that need to happen in order to be able to do that. So that's what we do. So yeah, primarily our clients are going to be RIAs, other wealth managers, and indirectly is going to be the end retail clients that those advisors are investing on behalf for, doing their financial planning, doing their estate planning. Incorporating digital assets is more than just investment solution, and we know that there's going to be other pieces within the wealth journey that a person will take, especially as we talk about the next generation of investors. I know we might get into some of that. But that's kind of where we see ourselves and where we've been adding value since 2020. And we launched in November of 2020. But for Arbor Capital Management, they've actually been allocating and had an investment thesis that stemmed from 2015. And I'd be remiss not to mention my business partner, Matt Koleski, who is co-owner and co-founder of Arbor Capital Management and co-founder of Arbor Digital, who has a very robust history in the Bitcoin network stemming from 2010. That's a little bit about me, a little bit about Arbor, and happy to take this to the next.
Great. Well, I'm very excited to talk about the demand side because I look at kind of digital assets as being both the supply and demand, right? So we can tokenize things, but we need people to buy them. And I remember listening to panels back in 2018 focused on secondary trading, which is a great idea, but in 2018, it didn't exist. And today it's still light. So, and this is kind of the institutional grade digital assets. So thinking about that, how do we take it to the next level, right? So how are your clients or RIAs looking at buying digital assets? Let's ask that first. Kind of what are the ones that are buying, what are they buying and how do they look at it? And then what are the concerns for those that aren't?
Absolutely. So I guess let's start what are they doing? And so I guess it's really important to understand what is available in the marketplace right now. And again, even speaking just 2 years ago, there really wasn't much available. GBTC is the most popular and most widely used vehicle to get access to digital assets because it was the earliest. And then you have your Bitwise products. The Bitwise 10 is very popular. So those two are really the main way that clients were interfacing, both RIAs and their end retail clients. But over time, there have been what we call DTAMPs, or digital asset TAMPs, or platforms that we can get access to get direct exposure. Now, it's taken a while for builders to actually go into that space and build the highest quality solutions for people that wanted to have something like a separately managed account or something that wasn't underneath a fund structure. So that's where we see that. And so that's where now in 2023, we have a plethora of options. Over the last 2 years, we've seen an explosion of different solutions for asset managers, asset allocators, and RIAs and wealth managers, not just to have these two fund structures, but now to have access to SMAs. We don't see the demand shifting yet from those traditional products yet because of that word traditional, because they are traditional fund structures. They're still easy to understand. Now, although they come with their own limitations, which we won't get into, but that's where we're starting to see the demand shift from these traditional fund structures, these private placements, now to these more direct exposure solutions like SMA, separately managed accounts, getting the investors closer to the assets, because what we're finding is that actually is less complicated for the advisors and for the wealth managers when they say direct ownership. And there's a lot of wealth managers out there who actually they don't believe in fund management. They believe in direct exposure, buying individual securities. So for them, it's a more comforting thing. But we're still seeing that demand shift, and we still have a long way to go. I would say there was a recent survey done by Bitwise and Vetify where they highlighted that right now, demand of allocation, 15% of advisors were allocating actively in 2022 or in 2021, and then it was the same. It remained flat for 2022, and especially given what we experienced last year, I actually see that as a win. We didn't see this extreme fall off. We didn't see that number go from 15 to 4, and I think that shows to the people that are getting engaged, they're here for the long run. So that demand is there. But I think, to answer your second part of your question, where do we go and how do we extend that and elevate that to get to the next level? I think there's two things. There are things that we think about which are in our control. So the things that are in our control are really developing the front end, the interface, the way that clients engage with this. And so when I say the word clients, I'm meaning RIAs and wealth managers. So right now, the limitation is that the front end is just not built out as well as it is in the traditional world. So if I'm an asset allocator in the traditional world, I can go to Schwab, I can go to JP Morgan, I can go to UBS, I can go to all the Goldman Sachs, and they have these phenomenal interfaces to where I can build a portfolio, scale it out, and completely release and do it within a very quick turnaround. That all doesn't exist yet. That is all still being built out. And that, I think, is one of the biggest hurdles. And that's going to be for what's in our control. We need to build that infrastructure out. I like to say this, financial services is the title of our industry. And we haven't gotten to that services part yet, because when you think about the relationship management that comes with advisors, there's relationship risk. So even though an investment may make sense logically, if the experience of it is very cumbersome, it does create a little bit of relationship risk that the clients don't want to go through. So I think that's the first thing. Now I'll go to what's going to take us to the next level outside of our control. And that's going to come down to regulation. I think 2023 and 2024 are going to be one of the themes we're going to see is the court battles that are going to ensue. I think one thing you're going to see is that a lot of relationships internally in the crypto markets that were developed between 2013, let's say 2018, 2019, using DCG and Gemini, or DCG Genesis and Gemini as a prime example of this, you're going to see these relationships that were founded. Those are going to be tested extremely, because now once there's real money flowing through all of these businesses, and now everyone's kind of doing things that they didn't understand, and now it's coming to light that maybe this wasn't what we signed up for, you're going to see that play out. So I think once the relationships get solved for, and then also on the regulatory front, when you see some of these battles play out, hopefully we get regulation, the SEC comes in, we get something that says, what is a security and what isn't? I think those guardrails especially for RIAs and wealth managers who are fiduciaries, and that's just not a word we throw around. And I think that word does get thrown around a lot in our industry. Fiduciaries have to do what's in the best interest of their clients. We have to safeguard client assets. So when we talk about that, we actually are accountable to being fiduciaries. If we can't just say we're fiduciaries and not do it. So I think that's where regulation is really important. So I would say those are the two things I think are going to take us to the next level that are outside of our control, really.
So 2023, I feel like the buzzword is RWA, real world assets, right? The tokenization of real world assets. So it's less questionable because we're talking about securities, right? So it's not, is it a security or not? But then part of that is, different companies are looking at democratizing private equity, for example, right? And giving more people the opportunity to invest in something that was otherwise offered to large institutions. But how do we get from, I guess, how are your clients or RAs thinking about this, or are they thinking about it? Is there a demand for this? And how do we get that in the hands of other investors? Right? Because not a lot has been tokenized for real world assets. And we can tokenize it, but we need to have the buyers there too, the investors.
Absolutely. And I think it's a great question. And I think for advisors, it's definitely going to be a much slower adoption. I think back to, and again, I wasn't in the industry during these times, but I've had the fortunate experience of meeting with and learning from people who went through the ETF boom. When ETFs were first presented to the industry through their journey to mass adoption. And I think you're going to see a history that will rhyme. It won't be the exact same, that will go through the same adoption when it comes to the idea of tokenization. Because to me, tokenization is just now a new vehicle in which to house assets. And the technology that has been afforded for tokenization, which is decentralized blockchain, but there's also private blockchains that's already doing this. JP Morgan's Onyx program is a prime example of this. And then what ARCA, what you all have been doing with the blockchain transfer fund. I mean, these are huge innovations that are happening that I feel like don't get a lot of talk about. And the reason is because it will follow that same trajectory. I think it may follow that similar trajectory where ETFs at the beginning were villainized. They were going to see it to be the death of capital markets. How can you use this structure? It's going to upend. This has nothing to do with what we've done with mutual funds and the traditional allegories of the industry. But what we saw was, it took a long time. It took at least 10 years from the early to mid 90s to probably even mid 2000s up until probably just after 2008, where you started to see the mass adoption of ETFs. And I think that will play out similarly to this tokenization. But tokenization is real. Real world assets are coming on chain. And I think the biggest way I can help people connect to that is look to about 4 years ago when this concept of stock slices came out. And it was a big thing at Schwab, Fidelity, and other players to be able to offer slices and slivers of stocks as opposed to having to go. Because one of the biggest, and you mentioned this word access, Annelise, which I think for me, I get very excited about coming from my background that I have, is giving everyday investors access to the bigger investments that everyone else is investing to. So traditionally, let's say, Apple or Tesla is trading at $2,000 a share. Many investors who don't want to completely put all their net worth in that don't want to put into one stock. But those that only have $5,000 of net worth now will be able to, through tokenization, be able to buy very small quantities and build percentage-based portfolios and wealth pictures, just like everyone else can, through tokenization. And that's where I think you're going to start to see that play out. But it will take a while because there's a lot of infrastructure that needs to get built in order for this to happen. And I guess the biggest players I see are you guys. And then I also see, BSTX, and I think that's owned by Overstock. And full disclosure, Arbor Capital does hold a position in Overstock. There's a lot of innovation happening on the tokenized realm, and it's completely separate than the crypto / decentralized infrastructure that we're being built. But yeah, it's going to be a hot topic coming forward because it's going to just enable all of these efficiencies that we've been screaming from the rooftops for the last few years.
So what about this from the shifting generational demand for investors? So do you see it different? Someone that's 30 and investing have a different idea of what they're looking to invest in, or 20 years old and investing versus someone that's 60 years old and they're investing, and not the idea of 60-40 stocks bonds based on their age, but I guess demand of, I want to invest in this because it means more to me, or I feel for it. Do you see a different generational investing thesis?
Mm-hmm. Absolutely. And I think that's where, as fiduciaries and as wealth advisors, we have a unique perspective of this. And I think there's a lot of conceptual pieces that people hear about, but don't quite see it and don't understand it. And that's where we actually get to live that, because we are actually ingrained with, older clients who have multi-generational wealth plans. We get to actually talk to those generations and say, hey, how are you thinking about when we build this wealth plan for your, dad, grandfather, whatever the case is? How do you see yourself coming into this when you turn 30 or when you're 25, whatever the case is. We get to ask those questions very early in the life cycle of our client relationships. So we do see this generational shift, and it's starting really with the millennials and then going out to the Gen Zers. And what I'll say is that the behaviors that they exhibit in terms of investing is radically different than what advisors have experienced with their clients that they've had for the last 20 years. And I think that shift is definitely coming to your point. And so what that means is, just like you said, they want to invest in things that matter to them. It's not necessarily just about alpha and return generation. It's about investing something that they connect with on a emotional level. And that's coming. And I shouldn't even say it's coming. It's already here. We already see people investing more value-based for their life. And that's only going to be enabled at a more scalable level by utilizing what is being built in terms of tokenization, blockchain technology. And it's going to allow advisors, and again, speaking to this demand side, it's going to take a long time. It's going to take a lot longer, but I think you're going to be able to develop even stronger relationships with those investors over the long run, because you're going to be able to build these multi-dimensional portfolios that align with them. And you don't have to sacrifice because of price or because we can't cut it up in the ways we want to, and it's not regulated. We can do it in a safe and secure way, but there is a long way to go in terms of infrastructure. But absolutely, that generational shift is already here and happening, and it's really going to, I think what we're seeing is this bit of catch up. Now, I think a lot of institutions were afraid they missed the boat and they were behind, not just from an investment standpoint, but from a technology standpoint. Like, oh gosh, did we not build the R&D enough for this? And one thing I think they're seeing now is that, oh, okay, we've got this time to catch up now. And when in our conversations we've had with some of the bigger institutions, is they see this as that opportunity now. And I think a prime example of that, and what you're going to start seeing, is companies like, Ernst & Young, E&Y, their release of Nightfall and their enterprise blockchain, where it's decentralized backend, but centralized front end. You're going to see more of that play out, and that's what's going to enable everything.
It's exciting, but I do think it's great to think about, 5, 10, 20 years out, right? What's the next generation as they come in? What are they looking for? And how this technology comes into play, kind of answering their question. Very exciting. Thanks, Marc. So we're running short on time. And from your podcast, which Marc's got a great podcast, I like the idea of asking questions and advice at the end. So I would love to turn this to you and ask what advice would you give to RIAs or investors in approaching the digital asset space?
Absolutely. And it's funny, it's weird being on the other side. Usually I'm on your side. So it's interesting to get to play that role now. But I guess my first piece of advice is get educated. And that's one of the things I get very encouraged about. And especially with what you all do there in terms of the education that you come out. I mean, even this series here that you do, education is so key. It's key to establishing the common language, which we still suffer from. It's key to developing a foundational understanding that separates the emotions of what this technology is to what we are working towards. And then I think education for the third piece, the third pillar of the education, is being able to communicate effectively. Right now, there are a lot, and I suffer this myself, and I work on this every day, is being able to communicate effectively what this truly is, and really to dumb it down. And so those are the three pillars, and that's the first place I would start if I'm an advisor. And then the second place is then do your market research. Talk to anybody and everybody. And I would say the biggest red flags then to look for are people who aren't looking to collaborate, who don't share, or not what we like to term open source, who aren't willing to just, kind of open the doors, but then who also don't give you other people, even if they are competitors. And I think that's one thing that separates kind of this industry and where we are as well, is like, even though we may have competition, everyone, it's kind of, we're all together in this so far. And it's like, what's the rising tide lifts all boats. So we're trying to, make sure that everyone is positioned well. So that's the second place. Do your market research. You aren't late. It is still even if it's 2024 and you haven't allocated or you haven't brought anything meaningful to clients, it is not too late. Take your time. And I think everyone wants to be rushed. And I think that's what we saw in 2021 and the beginning of 2022 is we saw this influx of demand without being educated or understanding first. And so then we saw some advisors and some people making some mistakes that probably they would have gone. And that, thankfully, for us, since we've been in this space a long time, we were able to avoid, and again, not just skill based, but that's very much luck based. And we don't want to pretend that everything is skill based for us. It's very much luck, but that's where I'd start. That's a long winded answer, but I hope it adds some value to your listeners.
Absolutely. Well, Marc, thank you so much for joining us today. Really appreciate it. I really enjoyed your insight. If anyone has any questions, they can reach out. I'm sure they can reach out to Marc. You definitely reach out to me. And if there are other topics you'd like us to cover on Tokenization Talks, please let me know. And in the meantime, stay well. And I hope to hear from you soon. Thanks. Thanks, Marc.